Welcome to Retirement GPS, navigated by Synergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to the Retirement GPS podcast. I'm your host, Ryan Zaharchek, certified financial planner and founder of Synergy Retirement Planning. And of course, as always, I'm here with my co-host, the man, the myth, the legend, our associate planner, Zane Belsack. Zane, how you doing today?
Hey Ryan, I'm doing great. Excited to be here and really excited to dive into today's topic. We're actually talking about something that might not sound exciting at first, risk management and insurance, but it's fundamental to your retirement plan.
It really is, and this is definitely one of the least exciting topics that we'll be talking about, but Zane and I are pretty good at trying to make it a little bit more exciting for you. We're going to try to pick it up a little bit and spruce it up so we can take a look and dive into risk management, take a dive into insurance and understand where the gaps are and how we can fill them. I always say it's like being the king of your kingdom, right? And we built this great castle and we're going to go out and conquer new lands. But before we can go out and conquer new lands, we want to make sure that we have high walls around our castle. We want to have a deep moat around our castle because we don't want to be out conquering new lands while we're being invaded from behind without even realizing.
You need to have those walls up before you can go out and defeat everyone else. I have a pretty good story I wanted to tell. My uncle has a good friend, let's call him Frank, who retired a few years ago. He and his wife, Sherry, had done everything right. They paid off their mortgage, they saved well, planned their income, and unfortunately, Frank developed dementia, and within 2 years of the diagnosis, he actually became so difficult to manage that Sherry had no choice but to put him in a long-term care facility. He actually lived for 3 more years, and it really costed them over $400,000 for his care that wasn't even covered by Medicare. And Frank passed away, but Sherry had to sell their home because she was running out of money, and it was just so sad to see.
It's really a perfect example of what we're going to be talking about today. Frank and Sherry didn't really do anything wrong in their planning other than having some blind spots that they just were not aware of. We don't know what we don't know. They did everything right in the early days and saved and moved in the right direction. But risk management is about finding those blind spots before life finds them for you. So seeing where the risks are and making sure we can either plug those holes or understand which risks we're retaining along the way. So here's the thing. In retirement, you're no longer earning a paycheck. You're living off of what you saved, plus probably Social Security, pensions, maybe some annuities. There's less margin for error. A single big expense, something completely unexpected, such as a lawsuit or a medical event that you didn't foresee, or a long-term care need that we all hope we don't have, but is a reality in today's world, can take years of careful savings and throw it off track.
Exactly. We're basically protecting the downside so your plan keeps moving forward.
And today we're going to break that down into 4 big categories, the 4 major categories of insurance that we focus on for retirees. Those are long-term care insurance, health insurance, typically when it comes to retirement, that's Medicare and Medigap insurance, life insurance in retirement, and liability coverage, which would be your property and casualty insurance. Let's start with long-term care insurance because that's one of the most easily overlooked insurances. Most people focus on health insurance and Medicare, and they're not thinking about long-term care. But the truth is, statistically, nearly 70% of people over 65 will need some form of long-term care. Long-term care is help with the activities of daily living, and there's 6 activities. Those are things like bathing, toileting, dressing, eating, transferring, the everyday things that we take for granted as you age and as you move into the last phase of life, you're just not able to do for yourself and you need help with. And the problem is that help is really expensive, which is where long-term care insurance comes in.
Medicare doesn't pay for that kind of custodial care, correct?
Medicare is designed to cover acute care, which is Short-term care, I broke my leg, I need care so that my leg heals and I will be better. Right? With long-term care, there is typically no better in sight. We move to a long-term care facility or have in-home long-term care help because we're most likely not getting better. This is not about acute care. This is not to cure you. This is to manage your needs for the rest of your life. So it's about ongoing custodial care. In New Jersey, that can be really expensive, and a decent long-term care facility, nursing home, can cost anywhere from $10,000 to $15,000 a month. We typically plan about $150,000 a year.
And that really sounds like it would ruin someone's budget, as it did for Frank and Sherry.
That's why we look at long-term care insurance as one of the tools in the toolbox. The reason why is because we get very concerned about bankrupting a spouse. We don't want a healthy spouse who is now paying for the long-term care needs of their significant other to ultimately go bankrupt because they don't have the ability to pay for those long-term care needs. So you can buy a traditional policy that will cover those long-term care needs, those specific daily or monthly activities of daily living, and there are specific amounts that are tied to those. Or you could buy a hybrid life and long-term care policy that pays for care if you need it, and if you don't need it, you get the death benefit.
And I've actually read about this, if you wouldn't mind defining it a little bit more, but what is the New Jersey Partnership for Long-Term Care?
Yeah, partnership program is offered through a lot of states in the United States. New Jersey does offer a partnership program, and in a nutshell, it's a program that lets you protect your assets from Medicaid spend down rules. So it can be really valuable in not bankrupting your spouse. If you get a long-term care policy, that policy will cover up to, say, $300,000 in benefits. If you go through the entirety of the $300,000 in benefits, you can keep $300,000 in assets and still qualify for Medicaid if you need more care. Whereas typically the Medicaid threshold is much, much less than that. You have to burn through a lot more of your assets. The partnership basically says if you get the protection that's right for you, the government will support you as well.
So I'm going to restate this for our listeners. It seems like it's basically just about covering the cost and protecting the surviving spouse's lifestyle.
Exactly. And in most cases, that's what insurance is all about. It's about protecting our loved ones. The best time to explore this, usually for long-term care, is between 55 and 64. Now, why is that the best time? Well, the truth is you could buy long-term care insurance when you're in your 30s, when you're in your 20s, and that's fine. And a lot of insurance salespeople will tell you, buy it when you're young because A, you're eligible, B, you never know when you're going to need it. My personal opinion is it's very rare for a situation where a younger person under the age of, say, 60 would have a long-term care need. Of course, there's always the famous Michael J. Fox example of early onset Parkinson's. And yes, that is, of course, a risk, but it's a very, very, very small risk. Most of the risk we're trying to protect is a long-term care need later in life. You don't want to pay premiums for 30 years, 40 years before you even start looking at potentially even needing this insurance. Premiums stay pretty low until you're in your mid-50s. So, waiting till 55, 56, 57 is a good time to buy long-term care. Once you hit your early 60s, 63, 64, premiums actually start to go up each year significantly. So they actually get parabolic. And in fact, you may not even be eligible by the time you're in your late 60s for long-term care insurance. So that's why we say usually between 55 and 64 is a great age to price out and purchase long-term care insurance. I think we talked enough about long-term care. Let's talk a little bit about Medicare. Medicare is the health insurance program that's provided by both the federal government and the state in partnership. The state issues Medicare, but it's funded in part from the federal government. Medicare has several different parts. Part A, which many of you probably have heard of, is the emergency care. That is the portion of care that covers things like hospital stays or hospice care if you're at the tail end of your life. So it's really kind of the emergency care. And the best part about Medicare Part A is you become eligible at age 65 and there's no cost. There's no premiums. Whether you sign up for it or not, you have Medicare Part A. What I mean by that is if you're 67 years old working at a job and you go to the emergency room because you're hit by a car, you can file for Medicare Part A to cover those costs, and then the health insurance through your job will cover whatever Part A doesn't. Then there's Part B. Now, Part B covers outpatient care. That is your day-to-day care. So doctor's visits. If you have a cold, if you have the flu and you're going to go to the doctor, that would be covered as Part B coverage. There is a premium associated with Medicare Part B. That premium is tiered based on your income. So you will have to pay a monthly premium if you are collecting and eligible for Part B. You are required to take Part B if you do not have private insurance through your employer. And what I mean by that is if you're 67 and you're working, you don't have to collect Part B, and there's no issues there. If you're 67 and not working and you have not yet signed up and are not paying premiums for Part B, when you do go to sign up, you will pay a penalty for not collecting or not paying your premiums for Part B from the time you were 65. And the purpose here is the government doesn't want you waiting until you're 70 years old and need heart surgery before you start paying premiums on your insurance. They want you paying premiums from 65 on, unless you're covered by another policy. There's also Part C, which we'll talk about in a minute, and then Part D, which is your drug plan. And we'll talk about that as well down the line.
And is that where Medigap or Medicare Advantage comes in?
Medicare Advantage is Part C. Medigap is a private insurance. Essentially, the way Medigap works is there are holes or gaps in the premiums and what Medicare actually pays for. So, first of all, you have deductibles, right, which means you have to pay that out of your pocket. Then there are places where Medicare doesn't cover. If you're in the hospital for more than 60 days, you may be on your own to cover some of your hospital bills. That's where a private policy such as Medigap comes in. Medicare doesn't pay for things like dental. So if you need some dental work, anybody who's had a root canal knows how much that can cost. Glasses, eye exams, and hearing aids, which can be a common problem once you hit 65 and older, is the need for hearing aids, which can be very, very expensive. That's not covered by Medicare. A good Medigap policy comes in to fill those gaps and pay for those things. And looking for those policies is really important.
I'm glad you mentioned that. That was actually my next question. But I also wanted to touch on prescriptions. Are those covered as well?
Yeah, it's a great question. So prescriptions are covered on Medicare Part D. That's your drug plan. So your drug plan also has a premium associated with it. Then there's Medicare Part C, which is the Medicare Advantage plan. Now, this is something that you mentioned earlier, Zane. The Medicare Advantage plan is actually a PPO or an HMO that would actually replace Medicare Part A, B, and D. You could go out and get a Medicare Advantage plan, pay Blue Cross and Blue Shield to handle all of it, including your Medigap policy. And when you go get a Part C Medicare Advantage plan, it really covers everything and it's all included together. Some people love it because it covers all these things. It's one premium and it's kind of easy. Some people don't like it just simply because now they're dealing with an HMO or a PPO. And if you've ever dealt with either one of those, you know that can be a little bit challenging. So, it's really different strokes for different folks. It depends what's right for you. The key is reviewing your plan every year. Your needs change and so do the plan costs.
And I wanted to also ask about supplemental coverage. Does that mean big out-of-pocket surprises?
Yes, and I've seen those surprises cost people $10,000 or more in a single year. It can be really expensive. Let's move on now. We're going to talk about life insurance in retirement. Typically in retirement, we don't recommend retirees get new life insurance. Life insurance is designed to protect dependents if something were to happen to you. And the example we like to use is, let's say I'm a 30-year-old married to my wife who's a stay-at-home mom. I'm working and I'm making a significant living supporting my family. We have 2 children with another one on the way. I have 4 dependents, my 3 children and my wife. So with 3 children and a wife and no other income, if something were to happen to me, those dependents would be absolutely devastated from an income standpoint. Of course, they would be devastated because the loss of me and I'm such a great guy, but that's not what we're talking about here. They're not going to be able to replace me with insurance. What they can do is replace my income. And that's where life insurance comes in. It's a lump sum of money designed to replace the income of the provider to make sure their dependents are not destitute. When it comes to life insurance and retirement, typically by then, you already have enough money to cover the rest of your life. So if it's a married couple who are in retirement at 65, I've received a call very recently from someone who wanted to buy a $10,000 life insurance policy to cover their final expenses. This is a person that had over $1 million invested with us and probably a $3 million net worth. And my answer to them was, what is it you're trying to protect? And they said, well, we just want to make sure my wife has enough to bury me. And I said, your wife has plenty of money to bury you. Why do you think a $10,000 life insurance policy will cover that need? And do you really want to be paying premiums to a life insurance company? Life insurance companies, like any insurance companies, are a for-profit entity. They're trying to make money off of you. They're charging you more for your insurance than actually makes sense, so they can turn that profit. So we don't need to go out and get additional insurance if we already have the assets to cover our dependents. If something were to happen to this gentleman, not only could his wife bury him, but his wife could live very comfortably for the rest of her life. And the reason we know that is because they're both retired. There is no other income coming in. She would lose a Social Security that was his, but she would also have all the assets that were his because they were being left exclusively to her.
There still are situations where it makes sense to get life insurance in retirement, right?
It does. And again, when it comes to anything in financial planning, it's never one size fits all. Certainly issues with closely held assets such as businesses, farms, large pieces of commercial property, that succession can be very difficult, and especially when it comes to estate taxes. So legacy planning and comfort of knowing that there's enough assets so you don't have to worry about your beneficiary. Somebody who is retired but just barely making ends meet in retirement could also use a life insurance policy. We typically don't recommend that members who are retired and have whole life policies or term policies that are expiring down the road, we don't want to see them get rid of those insurance policies. We like to see them keep what they have, but we typically are not looking to get new policies.
The key is asking, does it still have a job in my plan?
It's a tool like any other tool in our toolbox. If the answer is no, you can avoid getting additional coverage and paying extra premiums. Make sure that you have the right kind and the right amount, because that's really the key. Let's move on to liability coverage, which is the last type of insurance we're going to be talking about today, but it's super important. It protects you from lawsuits or claims, an accident, or somebody getting hurt on your property.
Your home and auto policies include that, right?
Yeah, for sure. When you go out and get a homeowner's insurance or auto insurance policy, the liability coverage is capped at a certain rate, which is typically why we encourage people to go out and get an umbrella policy. This is extra protection, often between $1 million and $5 million in additional coverage at a very low cost.
So the way that I think about it is if you're riding a bike, it's like wearing a helmet over your helmet.
Yeah, I mean, I guess that's definitely one way to look at it. I feel like it's more like getting extra padding in the helmet you're already wearing, just doubling up on the padding. You hope you never need it, but if you fall off your bike and you smack your head on the ground, that extra padding is better probability that you're not going to be scrambling your brains. So that's the way we think about your umbrella policy. If you do get sued for $200,000 or $300,000, your auto insurance, and this is a simple example of I go out and I'm negligent, I get into an accident, I make a mistake and I accidentally hit somebody. If they sue me for $200,000 or $300,000, that's covered by my auto insurance. They sue me for $2 or $3 million, that is not covered by my auto insurance. Most policies cover up to $500,000 to $1 million on the auto side. Having that extra umbrella goes right on top to say, okay, we have an additional $1, $2, $3, $5 million in coverage if I do get sued. The higher the net worth, the more coverage you want to make sure that you're protected. So let's pull it all together. Protecting your journey in retirement means looking at long-term care coverage, Medicare insurance, and of course Medigap, life insurance if and when it serves the right purpose, and then liability coverage for accidents and lawsuits.
So it's like packing for a road trip. You're not just thinking about sunny days. You're making sure you have a spare tire, a first aid kit, and a raincoat, just in case.
So the action step for today, if you're listening and wondering where to start, here's what we recommend. Read our blog, Mile Markers. The link to that will be in the show notes. So we'll have this detailed out and we'll have some additional components and action steps for you to move through the process of making sure you have the right insurances in place for your needs. Review your insurance basics. Do you have long-term care insurance, adequate Medicare insurance and supplements, enough liability protection, and is life insurance right for you? Have the conversation. Sit down with your spouse or your partner and talk about the what ifs in your retirement plan and what are you missing? What are the blind spots that you might not be thinking about? And schedule a review. Bring your completed scorecard to your next planning meeting so we can close the gaps together and talk through what's the right fit for you. Remember, protecting your journey is just as important as mapping it out.
If you're not already following us, you can find Zinergy Retirement Planning on Instagram, Facebook, and LinkedIn at Zinergy Retirement. We post regular tips, checklists, and updates to help you stay on course.
And make sure, as Zane mentioned, you're following our podcast, you're subscribing. Please give us 5 stars. The more 5-star reviews we get, the more we can help you. Until next time, stay intentional, stay informed, and happy planning.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog Mile Markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.